Bitcoin has seen some tremendous growth over the last decade. Bitcoin is what started the entire crypto industry. But is Bitcoin going to help with fixing the economy? For now, I can confidently say no, it won't. And we're going to go through why. First, by mentioning some of the commonly known issues with Bitcoin, and then finish up with the economic problem that isn't commonly known or even covered anywhere online. Bitcoin was launched in 2009. It currently can handle a maximum of 7 transactions per second. This clearly cannot handle global scale. For instance, the average transactions per second for Visa alone is 25,000. That's just payments and one provider. The second problem is programmability. Bitcoin isn't very programmable. You can't easily write code to create new contracts. So Bitcoin doesn't help very much with replacing centralized services like social media, marketplaces, and other digital platforms. The lack of programmability and limited transactions per second means if you want to use Bitcoin in a manner that is more cost effective, you need solutions that are built on top of the network. These are commonly called layer 2s. They're often completely separate networks that use Bitcoin for security by submitting a verifiable note as a transaction on the Bitcoin chain. This is kind of like a checkpoint of the layer 2 network's current state, which will then mean that anyone can prove the state of the layer 2 is correct. The problem with this approach is if the layer 2 network becomes secure enough on its own due to its scale, there's a huge incentive for that network to just not submit transactions on the Bitcoin network, as doing so would dramatically reduce the cost of operating that layer 2 network. And that also brings us to the next topic of security on Bitcoin itself. Currently, around every 4 years, there is a Bitcoin halving. Bitcoin groups recent transactions together into something called blocks. The miner that is the quickest at solving a math problem is rewarded with being able to verify the next block and then propagate this to the rest of the network. They are rewarded for doing this. The halving event simply means the amount they are receiving is halving roughly every 4 years. So, if miners were receiving 12.5 Bitcoin per block, after a halving, it would go down to 6.25 per block. The problem with the halving events is if the price of Bitcoin doesn't increase, the security budget that comes from coin expansion is halved. The justification for this is that the network should experience more adoption over time, and the number of transactions should also be increasing to pay for the miners that secure the network. Well, we know the transactions per second is limited to 7, so the only way you could cover for the reduced budget is by increasing the cost of the transaction. The higher the cost of the transaction, the more there is an incentive to find alternative solutions. The less viable it will become for your average user who doesn't want to pay that much for a transaction. The higher the market cap of Bitcoin and the lower the security budget to pay for node operators, the more there is an incentive to attack the network. And that's because the smaller the security budget, the cheaper it becomes to attack the network. Bitcoin is on an unsustainable path. The security budget keeps halving every 4 years. It needs transaction fees to cover for that loss of budget, or for Bitcoin to double in price. The transaction volume is limited, so the price of transactions would need to go up. If Bitcoin price goes up, well, this means more expensive transactions using the same amount of Bitcoin per transaction. If demand for transactions increases, well, transaction volume is limited, so the transaction fee has to go up. In either scenario, the price of using the Bitcoin network goes up, which greatly increases the incentive to use alternative solutions. And what about these alternative solutions? Well, they're innovating and getting better and better all the time. Highly programmable, new functionality, faster and cheaper transactions, and more applications and services. This trend will continue, so the reasons to use these alternative networks for your daily needs only keeps increasing. Automation in payments and trading is also not favorable for Bitcoin. When they're moving around small amounts of money or assets, they might as well use the cheapest network to achieve that outcome. AI and automated solutions can identify and then use whatever approach is most cost efficient. And that solution is not going to be Bitcoin. All right, that's enough of the more well-known problems with Bitcoin. I've added one resource in the description from Justin Bonds, who is well known for critiquing Bitcoin. And of course, you can find a number of other resources if you look online. Let's now talk about the economic problems with Bitcoin. In previous videos, I talked about the problems of storable money, and these same problems apply to Bitcoin. Bitcoin will become increasingly reliant on transaction fees in the future. These fees will be required to compensate node operators that operate the network. Bitcoin is storable. If you hold Bitcoin, you are never charged anything. It's completely free to hold. Holders of Bitcoin don't need to contribute anything towards the network at all. So the only people who are paying for the network are those that are actively using it. The more that people use the network, the larger the amount of fees they will pay. One of the most important use cases for these networks is transactions. The whole idea is they enable economic activity, enabling people to transact with other people and businesses. The network is reliant on transactions to pay the miners who operate the network. So, if all of the operating costs are attached to transaction fees, it is the most active users of the network that are being punished, as it's these users that have the responsibility of paying the most in fees. The people who simply hold Bitcoin, that don't transact, and that are actively trying to avoid transactions as much as possible, well, these people are rewarded the most. They get to benefit from a secure network that other people are paying for. Buying or receiving Bitcoin and holding it and just leaving it isn't a productive contribution to the economy. Storage of Bitcoin also doesn't help to pay for operating the network. What's even more problematic is the act of storing Bitcoin is even rewarded. The more that people store Bitcoin, the less Bitcoin there is left available to use for transactions. So, if the demand for Bitcoin for the use case of transactions remained the same, and more people stored Bitcoin, then the same demand exists for a smaller amount of the remaining supply. Now, the outcome of a reducing supply with the same demand is it would likely increase the price of Bitcoin. And this outcome proportionally rewards the people who have been storing the most amount of Bitcoin. They benefit from any price appreciation. Active users get the worst outcome. A more expensive Bitcoin leads to more expensive transactions. So now they are paying even more to use the network. This only further incentivizes active users to find alternative options. And the very same incentives encourage holders of Bitcoin to hold even more as the price keeps going up. The Bitcoin network eventually relies on transaction fees to sustain itself. So, punishing active users with higher fees and rewarding those that leave the coin idle and do nothing with it, well, this is not a sustainable economic model. Another issue with storable Bitcoin is it enables compounding returns and consolidations in ownership. And that's because it can be lent out in fully collateralized loans. This leads to zero or low risk unearned income, which can then generate compounding returns over time. For instance, someone could use their house, gold, or another asset as collateral, and the lender would receive this collateral in the event the borrower cannot repay the loan. If Bitcoin can consolidate into the hands of a few people over the long term, it isn't going to be a very sustainable economic system. It becomes a system that perpetually benefits a small subset of the population. This means that the increasing adoption of Bitcoin will eventually contribute towards creating the same problems of wealth inequality that we already see today. Let's think about the differences between gold and Bitcoin as a store of value. Gold exists by itself. It doesn't need you or anything else to just sit there and exist. It'll be there in the future whether you're alive or not. Gold doesn't care what you do. Gold doesn't need to care about anything. Bitcoin does not have this luxury. It only exists due to the active operation of the Bitcoin network. And it's the miners who are responsible for operating the network. If miners aren't rewarded for their work, well, there's going to be little incentive for them to run servers that operate the network. Servers that are costing them money to keep online. So Bitcoin needs a sustainable economy if the network is going to survive. BTC as an asset is reliant on the Bitcoin network being operational. If the Bitcoin network fails, well, at best, BTC as an asset becomes just a token on another network. So that's like basically a meme coin, but with a more interesting history. This is why Bitcoin and all Web3 networks need demerge. A demerged network coin is one that has carrying costs, which means holding the coin incurs some form of loss, such as due to fees or decay. The most compelling approach to implement demerge so far is a network coin tax. A network coin tax would mean any wallets are periodically charged a small percentage amount of the coins they hold. Let's apply a network coin tax to Bitcoin. An example rate of demerge could be 2%. That means if you held Bitcoin in your wallet idle for a year, you would lose 2% of that Bitcoin each year. The opportunity with this tax is it means you could reduce the transaction fees, as the network coin tax could help to pay for operating the network. This means you're no longer reliant on transaction fees. And this completely changes the incentives. Now, active users are not being punished as they are able to submit low-cost transactions as frequently as they like. Users that just store and leave Bitcoin idle are the ones who are punished with a small tax. They are now incentivized to use their Bitcoin more productively, such as by investing it into a business or a property, or by spending it on goods and services. Now, I've covered demerge in more detail in a separate video. Go check my videos on why money is broken and why Web3 needs demerge. I'd recommend watching those videos to learn more about demerge. If Bitcoin adopted demerge as a solution to improve its economic incentives, would this make Bitcoin a viable solution for fixing the economy? Absolutely not. The other issues I mentioned previously are still just as relevant. So currently, I'm struggling to see how Bitcoin will be very relevant in the future economy. And that brings us to some closing thoughts. I have no doubt that Bitcoin will continue to exist for a meaningful amount of time, and that the price might increase dramatically for certain periods of time. But the price of Bitcoin going up does not correlate with the creation of economic systems that are actually beneficial for society. Unfortunately, we are yet to see much adoption of demerge across Web3 networks. However, once we've created better Web3 networks that adopt these economic ideas and that facilitate a large amount of use cases, the need to use or hold Bitcoin will only keep reducing. Bitcoin might be one of the most important innovations we've ever seen. It's led to an entirely new industry with new and compelling ideas about how we could structure society. But Bitcoin itself, as it's currently implemented, isn't going to fix the economy.